and let's say your modified payment was $1,500. And let's say you never missed a payment. You made your $2,000 payments and you got into this temporary trial program and you made your $1,500 payments. Now, what you might not have known, and what Treasury allowed the banks to do, was to charge and accrue a late fee, a penalty, for each month that you actually made your on-time $1,500 payment under the justification that you were late on that original $2,000 payment. Now, what would happen is you wouldn't see that up front, but that the bank could accrue that fee month after month. So before long, these 3-month mod trials became a year, 12 months of ranking up these monthly fees. And then Treasury told the banks, listen, if you convert this and make it into one of our permanent Treasury modifications, you got to waive and write off all those fees. But if you foreclose, if you pull the rug out from under the homeowner, you actually get to keep all those fees and cash in them during a foreclosure sale. So for a mortgage servicer, at times it actually became more profitable and more of an incentive to string a borrower out and throw them on the scrap heap than to actually go through and do what the policy required and follow the rules and do permanent modifications. And to answer your question, this was something built into the program. We had warned Treasury about it. We explained to Treasury that this was not in the best interest of the program. And we also raised to them that the banks were using this to really violate the rules and trample over homeowners' rights by quote-unquote losing documents and really just ignoring the rules. And the response from Treasury was basically nothing. They refused to hold the banks accountable, even after anecdote after anecdote, instance after instance of misconduct. They came up with different excuses of the week. One week it was they're afraid if they punish them they would leave the program. Then there was something else. Well, we don't have the legal authority. But at the end of the line, they never did anything, and in part because, look, that's not what it was about. It was never about helping homeowners. It was helping to foam the runway for the banks. And when you understand that, so many of the failures of the programs and sort of the strange things like these fees suddenly made sense.
It seems that there's two places where a lot of this could have originated. First, in the writing of the legislation. This had to be written by Congress. And the second being the notion of regulatory capture. I'm curious, and regulatory capture, like, we had an example a couple of weeks ago where a guy used to work for Monsanto and then he took a much lower paying job at the USDA or FDA, approved one of their products, and then went back to work for them with a giant bonus. And a lot of these agencies, the military is famous for this. If you're a general and you order enough jets, you'll have $1 million job waiting for you when you retire. Those kinds of things. Are we looking at regulatory capture? I mean, has that actually happened at the Treasury Department? Or was this just crummy legislation, the banksters getting their lobbyists to insert these kinds of things into this legislation, or both?
Look, Treasury is a thoroughly captured agency, and I saw that. That's how so many of these decisions got made. The revolving door between Wall Street and Washington, where people go back and forth from government service to working at these financial companies, is very much a problem. And because they bring that Wall Street ideology with them when they're coming from Washington, and part of the problem is, as you were pointing out, is the promise of a big payday if you leave the government. Tom, I was told point blank in 2010 by a senior Treasury official, guy running the TARP, point blank, that I was causing harm to myself. My wife was pregnant at the time. We were about to have our first kid. And he said, you're doing real harm to your future for you and your family because of the harsh tone that you have towards the government and towards Wall Street. And he said, what do you want to do afterwards? If you want to get a job on Wall Street or move up in the government, you have to change your tone. You have to have a more positive tone. And then all sorts of things were possible, maybe even a federal judgeship from the Obama administration. And that it was sort of shocking to me that it was posted in such a blatant way. Right. But that's the same decision that's facing every regulator in this country. Do I play ball and ease up on Wall Street and therefore have the promise of getting a rich payday, or do I do my job and be aggressive and potentially not only cut off that opportunity, but draw the anger of my boss who came from one of those banks and has that ideology as well. And that's a real problem in our country. Yeah, it is. It is in a multitude of industries. Neil, we have a little less than a minute left. I wish we had another hour. Where does this go? Are we set up now for even more disasters as a consequence of this? I think we are. You know, one of the big fuels for the last crisis, one of the big causes, was too big to fail banks, and the perverse incentives that they have that drive them to take more and more risk, confident that if their risks pay off, they get to keep the money, and if it fails, the government will bail them out. Those banks are now about 25% bigger than they were before the financial crisis because of government policy that encouraged that consolidation in the beginning of the crisis. So they're bigger, they're more dangerous than ever, and it seems almost inevitable that those incentives are going to lead us down the path to another financial crisis unless we take control and break these banks up.
Amazing. Neil Barofsky, thanks so much for being with us and for writing this brilliant book.
Thank you.
To see this and other Conversations with Great Minds, go to our website at conversationswithgreatminds.com.